Welcome to another session on corporate accounting illustrations. Here we're going to calculate the value of right. Like how I'd shared another calculation in a video titled Q1. The other one that I had prepared, the one that I'd shared earlier, was done in Malayalam, and this one is going to be in English. Let's look at the illustration. XYZ Limited decides to increase its share capital by issuing additional shares, where one share will be given for a shareholder owning 5 shares, which means if I own 10 shares, I will get 2 shares by virtue of my preemptive right. So we're talking about rights issue here. The market price of a share is rupees 300. So at 300, XYZ Limited is trading today in the stock exchange. The issue price of the new share is rupees 150, so which means it's going to be offered at a discount to the existing shareholders with a premium of rupees 50. Calculate the value of a right. So the catch here is that in the last but one sentence it's mentioned that the issue price of the new share is rupees 150 including securities premium. So in 150, that rupees 50 of securities premium is already included. We have two formula to calculate the value of right. One is market price of share minus average price of a share. The average price is not given in the question, so we need to derive that. And the second formula is market price minus issue price divided by number of old shares, which means existing shares, plus 1, and that 1 is more of a computational factor mentioned as a part of the formula. We move on to the calculation. We need to derive the average price. So how do you arrive at the average price? You need to add the market price of existing shares with the issue price of the right shares and divide that by the number of existing shares and the number of right shares. So let's substitute. Market price of existing shares is equal to 5 multiplied by the market price. What is 5? The existing holding is 5. So if you hold 5 shares, you'll get 1. And if you're holding 10, you get 2. So market price of existing shares is calculated by multiplying 5 multiplied by 300, giving you 1500. The issue price of right shares is 1 into 150. That 1 is representative of the proportion at which the share is given. So if you're holding 5 shares, you're given 1. If you're holding 10, you get 2. And in multiples thereof. So the issue price of right shares is 1 multiplied by 150, giving you 150. Let's substitute that to find out the average price of a share. The market price of existing share is 1500 plus the issue price of right shares 150 divided by number of existing share, that is 5, plus the number of right share, which is 1. That's equal to 1650 divided by 6, giving you 275 as the average price. So now we have the average price derived. Let's substitute that into the first formula. Value of right is equal to market price of a share minus average price of a share. Market price is 300 and the average price now derived is rupees 275, and therefore market price minus average price is rupees 300 minus 275, giving you rupees 25 as the value of right. That's one way to calculate it. Let's look at the second formula, which is much more easier. Market price minus issue price divided by number of old shares plus 1. The market price is 300 minus issue price is 150 divided by number of old shares is 5, and 1 here represents the computational factor, which is a part of the formula. So 5 plus 1 is 6. 150 divided by 6, you get 25 again. That's all about calculating the value of a right.